The magic formula behind choosing passive income: a 1 billion worth of capital, 10,000 apartments, huge return with zero money of your own. Hello everyone, this is Matthew Scrooge and I'm really glad to have you on my channel. I've seen all the videos that you can find on YouTube on the subject of passive income, and to be honest and straight with you, it's terrible. I'm very disappointed with the quality of materials that I found. Probably I haven't seen all interesting materials on these subjects, so if you have a good video to suggest on passive income, please share it down below in the comment section. It would be extremely helpful. To me, the videos that I've seen don't cover the key element. Once you have the idea about the passive income and you sort of have chosen it for yourself, how you should approach passive income, how should you evaluate the passive income idea, how you can calculate how much income you're really gonna get from it. I've seen all of these videos and they don't cover this key element. How can you choose one? How can you find one? How can you create one? How can you expand one? How can you evaluate? And this video is going to cover exactly this topic, how you can evaluate your passive income idea. By the way, do not forget, please hit the like button and subscribe to my channel and switch on notifications button. Back to my personal story. I've done management consulting in Accenture strategy, and I've been around 8 different countries working on different projects in famous large companies like Pepsi, Coca, Emirates, Etihad, Mondelez, ABINBEV, Philipp Morris, all similar companies. And I can tell you from my experience that everyone, all investors, managers, everyone is chasing the same dream: to have a stable, uninterrupted income without much effort. In other words, passive income. And by working with all these different clients of mine, I now know how it is done. I've seen it with my own eyes hundreds of times. I've seen top executives, investors getting passive income in their businesses, in their companies. I've seen young entrepreneurs who have built passive income for themselves and destroyed it later on down the road. I've seen people who lose their passive income for stupid mistakes and get passive income for nothing. And finally, I've achieved passive income myself, the story that I shared in my previous video. Now I tell you the ultimate solution, the magic formula behind choosing passive income that is right for you. And it is a multiplication of 3 factors. Have a look at this diagram. So that's the diagram that shows that every passive income idea should be evaluated by 3 key components, which is investment, return on investment, and risks that are involved there. Every time you want to make a radical decision in life about new passive income, you should diligently calculate the 3 factors: investment size, the return that you're gonna get, and the risks involved into this business venture or passive income venture. I'll tell you a story from my personal experience. I was always trying to understand how business world works, how passive income is generated, how people get rich, how new businesses are getting started. I lived in Europe at that time. It was like 8 years ago. And the clients that I worked for, well, there was nothing remarkable about them. But then I got an internal opportunity to relocate to Dubai office, to Emirates. So I relocated there with my employer at that time, which was Accenture, a very big famous company, and I'm very thankful for the experience I got out of it. I got an offer to move between the offices. That was a very big step forward for me. It was a great adventure and great exciting experience overall. Dubai is a super nice place, shiny, beautiful, hot, and active in terms of the business. I liked it very much. I relocated there alone, landed there, started living in a hotel for initial time, and was very happy with everything. Found new friends, was going swimming every day, going clubbing every other night, enjoying the weather and the city lifestyle. So one day I started to look for the long-term apartment that I'm gonna rent while I stayed there. So one day I was viewing an apartment to rent for long-term. This viewing changed my life forever. I suddenly understood how the great capitals are made and get destroyed sometimes. The guy who showed me the apartment, Robert, was an agent in the Dubai Premium Estate Agency. And that agency worked just one single owner who owned 10,000 apartments only in Dubai, Mr. Abdul Halil. So how did it happen? I started to question this guy. How did his fortune come that way? It turned out that the owner was buying properties with a very, very low upfront payment, down payment, and a low interest on his mortgage. Plus, in Dubai, the rent is usually paid 1 year in advance, upfront. So Mr. Abdul Halil basically collected first rental payment to cover mortgage down payment and was getting new properties virtually with $0 down. Plus, the Dubai property market was growing for several consecutive years and the properties appreciated in value and his real estate portfolio grew further. That was a truly eye-opening experience, at least for me. How you can create basically a 1 billion worth of capital, worth of real estate with zero money of your own to make the down payments. So what learnings do we have from this story? The owner started his empire with a little investment of his own and a very, very high risk rate, because when you take a mortgage on your property of 90% of the value of the property and you have a down payment which you get partially from the first rental payment, is a very, very risky enterprise. The positive thing about this venture is that the owner had a huge return on his investment, on his capital, because he had so little down payment of his own money. He had every dollar that he earned on top of the expenses that he had was his profit, and basically percentage-wise it was very high. With very little down payment, every dollar that he made on top of the interest payment was his profit. And because his own money was just a fraction of property value, less than 10% actually, he could have achieved 100% return on investment per year and up to 300% return on investment per year with the real estate, with every new tenant that he got. Here's a breakdown of his values. For example, you buy a property for $500,000 with a 4% interest rate. You make a down payment of $50,000, which is 10% of the value of the property. Then you get a first year rent payment from the tenant of $50,000. $20,000 of this money goes to cover the interest rate for the first year. $15,000 goes towards debt repayment to increase your equity, basically to pay down the mortgage that you have. Only $15,000. So that's basically already your profit. And $15,000 are remaining. You can use it in your new properties. It means that your total investment is just $35,000 in the property, and you get a $30,000 return on investment, which is around 85% return on investment alone. Plus, the owner had a fabulous time when the value of the properties in Dubai was growing, and the properties appreciated by an average of 5% per year, which is another $25,000 per property, given this example. The total return on investment, therefore, goes as high as 156% per year, which is a fabulous return on real estate investment that you can have. However, the enterprise proved to be very, very risky. The operational costs were fixed. Basically, he had to make the payments for his mortgage, he had to make the interest payments that were fixed, and plus some staff and maintenance issues and exploitation costs with the buildings that were fixed year by year. Debt was huge relative to his equity and relative to the total asset value. So the whole enterprise was built upon an assumption that there will be a 100% occupancy by tenants, which was a case several years in a row. Also an assumption that the tenants would be paying on time and 1 year in advance all the time. There will be no additional operational expenditure whatsoever, like administrative or office costs. He didn't take into account all of these expenses, and they basically didn't exist for some time, nor any other unforeseen expenses. And another assumption that was made is that the value of the properties will not depreciate and potentially will increase in value as it did for several years before. But the crisis came. Well, actually not even a crisis, just a recession. Just a simple small recession. Number of tenants shrank because the business activity in Dubai dropped a little bit. And the occupancy dropped just to 90%. Plus, the tenants stopped paying 1 year in advance and started to pay by quarter. Basically, his cash flow changed forever. And worst of all, the value of real estate itself dropped by somewhat like 12% overall in just 1 year. Guess what happened next? The cash flow became negative, meaning that the owner didn't have enough of income in cash and of income in rent payments to cover his ongoing interest and debt repayment payments. Plus, as the value of properties fell down by 12%, the entire portfolio became worth less than the debt value that he had at that time. And unfortunately, the banks foreclosed on most of his properties. They started the bankruptcy procedure. The entire real estate empire crumbled down once Dubai real estate market went down just a little bit. It can be called like a margin call, because like when the debt value exceeds the total value of your assets, you get a margin call. That's basically what happened during 2008 banking crisis. As soon as the value of properties depreciated by 10 to 20%, the entire portfolio of properties get so-called a margin call from the banks when the total debt for the properties was higher than the market value for the properties. Basically, in other words, there is no sufficient collateral to repay the debt. Banks, in the fear that the situation might worsen, started to call back their assets and force the owner to sell the property, forcing the value of the properties to go even more down, because basically he had to rush to sell off the properties even at a lower price. When you are forced to sell something at the wrong time, you are getting destroyed all of the value that you have created before. So the banks started to foreclose on Abdul Khalil properties, one after another, bringing him to a complete bankruptcy in a matter of few months. That's a sad ending for this guy, but a very important learning for myself. Owning properties and owning assets leveraged by huge debt from the bank is a very risky enterprise. From time to time, many billionaires and entire economies get into the same trouble of borrowing too much money. Just like Ray Dalio, for example, in his Principle of Economics Machines, explains there is never a perfect balance between debt and income and value, and there are always going to be times when people borrow too much and there is a bubble in the economy, and then they cannot repay the debts promptly and there is a recession. The smartest people, though, who know when to borrow and when to sell, are going to harvest the most profits, because they buy at the right time when the value is low and they sell when the value is high, and they never get leveraged too much, and they have always high amount of cash on hand to cover unexpected things. So to put it in a nutshell, when you have an idea about new passive income and you want to evaluate, you understand how much money and effort you need to put into this venture, basically making it an investment size. The second thing, you evaluate the return you're gonna get on your investment. 10, 20%, 100%, 200% per year, whatever it is. Like the net value you are going to get after a year, after all expenses. That's the point number 2. And now the point number 3, you should understand and ideally calculate in the monetary terms the risk rate that you have, that you're gonna get. What can go wrong with your passive income? Just like in this story, can the value of the business go down? Can the value of the properties go down? Can the tenants disappear? And by how much? Can one of your partners force you to repay the debt immediately? Or can one of your subcontractors let you down? And what will happen in this case? Do you have enough reserves to cover these losses? How can a minimum income be guaranteed in your business? Can it be guaranteed at all? Can you guarantee some part of revenue in your business at all? If not, you cannot take any debt then. The rental market is very stable. Despite any crisis situation, they are going to be the tenants, but the value they're going to pay is fluctuating. But for example, if you have a furniture sales business, you cannot expect customers to be forever there. There are going to be periods when you're going to have no income at all. So you basically cannot be leveraged whatsoever. But in the property market, you can be leveraged. Let's say the good ratio would be 1-on-1 between your equity and debt, and so forth. You need to apply like different metrics when you are choosing the industry that you want a passive income inside. This is one of the hardest topics you can learn in your life and like acquire with a passive income idea. But that's the beginning. Everything else goes out from it. You learn it, you get to know it, and you own it. Thanks for watching. Thumbs up, hit the like button, and see you on my next videos. Please don't forget to subscribe. I'm very glad to have you on my channel.